How you doing, guys? Welcome back. It's LSP. It's currently the 31st of May 2021. So as promised, I'm going to be doing a video talking about some basics of price delivery. I obviously get a lot of questions, and it can sometimes be very difficult to answer those questions, in chat form or in messages, emails, that sort of thing. So I want to kind of do an overview of some of the things that are really important with price delivery, and then on the last slide we'll kind of go through a short example just to put it all together. So what you see here, okay, is a fraction of what is important. Okay, when I look at the charts, I see pretty much everything that you're looking at here, or at least this is what I'm looking for. Yeah, and each one of these things, along with some other things, tell me a story. Okay, open liquidity, where is it? Opposing liquidity, the wicks, negation, efficiency, gaps, equilibrium, all of this stuff, order flow, pickups, and so on. It's all right there in front of you on the chart, okay? And you have to be able to put all of this into context. You have to be able to put all of this in a place where it makes sense. For example, it's no good saying, well, there's a gap there, so I know price will eventually fill the gap. Yeah, this is a fallacy, okay? Because the filling of a gap in this example is dependent on the context of the market, the context of what's going on the day, the week, the month, and so on, and what happened previously up to that point. If anybody knows anything about gaps, for example, a breakaway gap hardly ever gets filled, and then you have things like, resting orders. How does that relate to? Like, the concept of a resting order means that at a specific level, there will be orders resting. Limit orders, for example, will be sitting there, and then when market hit, when the when price hits that level, the limit orders get triggered, and then off we go. The question is, resting orders as a concept makes sense, but when you're looking at the market, you need to be able to find out where those resting orders are, or where those resting orders are likely to be, based on everything that you've seen up to that point. Sometimes you have to look back a month, sometimes you look back 2 months, sometimes you look back a couple of days. Just depends. So there's a lot going on. It's not just one fits all. It's not just a system or a methodology. It is a way of understanding price. It's a way of reading the markets, okay? And then once you understand how to do that, you can start working on timing, you can start working on risk management, you can start working on other things. But you have to have a good understanding of all of this stuff first, okay? One candle does not tell the story. This is something that I used to struggle with quite a lot, in the early years of my trading. I don't want to say career, but my trading journey, so to speak, is I used to put a lot of weight on candles, one candle or a two candle combination, for example. Anybody that's been around long enough and, has read candles for some time, you'll know the classics, the dojis, the hammers, the inverted hammers, bullish engulfing, bearish engulfing, which is quite a popular one. These are all the pattern recognition candles. They do have a use in the market, but again, for example, a bearish engulfing pattern only works when it is one on a higher time frame. Well, it's not only works, but it works more consistently when it's on a higher time frame. And the context is there. More importantly, the context. Prices ran up. It's gone into an area of liquidity. Now it needs to go to opposing liquidity. We've had objective fulfillment. We've had a nice bearish engulfing candle, combination, and then somebody tries to short for it. This is there's a lot there. It's not just, well, it's a bearish engulfing, so I'm just going to go short. It's not the way it works. You have to be able to understand everything up to that point. So one candle does not tell the story. Okay, and when we see these big strong candles, there are a few instances where one candle can give you a lot of insight, okay, but that candle or those candles or those instances have to be extremely specific and very, very aggressive, in the way that they form. Volume does not tell the story. This is in my opinion, probably very close to indicators, in the way that I view this. Volume is probably one of the most misunderstood concepts in the markets, bar none. Okay, people look at volume and they convince themselves that volume actually has some merit. They'll look at volumes on their charts. They'll look at volumes with volume indicators, on balance volume with a line going on their charts, and so on and so on and so on. And for example, when you see price starts to run up and then it capitulates at the top, meaning it goes parabolic and there's no liquidity left and you get a really nice strong push, okay? Right at the end, you see volume increase, right? And you say, well, there was an increase in volume. The problem with volume, okay, is it doesn't tell you where the orders are. It doesn't tell you whether they're buys, they're sells. All it tells you is that there's, something going on in the marketplace and the volumes are increasing. Now, me personally, I used to look at volume, and I did it for about a year and a half, and I wasn't able to find a place for volume in my toolkit, because I would often get into trades where the volume, would supposedly be increasing, and then all of a sudden price would go the opposite way and I would get stung pretty badly. And I'd be like, well, wait a minute, price has just broken out, the context looks great, volume looks good, why is this reversing? Because it's a bull trap. It's a retail trap, and that's what happens. And obviously I'm talking about stocks right now, so there's a lot of market making manipulation and so on. So the other thing with volume is that you can hide volume. And it's not always accurate in the way that it's delivered to the marketplace. So we have to be very, very careful. Personally, I don't use volume, but you have to be very careful if you do, because for me, it will never be able to tell a story the way that we want it to tell the story, so we can have confidence in the analysis and the trade decisions, investment decisions that we're making. Indicators do not tell the story. Again, I've had so many arguments over the years about indicators. I have a general rule of thumb that almost all indicators are lagging indicators. And somebody once said to me, this particular indicator or that particular indicator is not a lagging indicator. Yes, they are. They're all lagging indicators. They have to be. By very definition, an indicator has to be a lagging indicator, because the indicator will only form based on price. So price is delivered, then the indicator is formed. Price is delivered, then the indicator updates. It updates. So you're always anticipating what the indicator is telling you. It is they are lagging indicators. Do they have a use? Absolutely. Indicators, depending on which ones you use and the combination of how you use them, do have value. Okay. Me personally, because I like to look at charts in a clutter-free way, I prefer not to have indicators on my charts. The only indicators that I would use if I was forced to use them would be RSI, okay, and MACD, because they're the two indicators that I can personally use to find positive and negative divergence, and it is an extremely powerful combination, right? So if you can find that and you understand what positive and negative divergence is, it's brilliant. It does work, but again, generally more potent on the higher time frames, and you get a much longer run on the higher time frames. So that's maybe something that you might want to look into. Just do a search for it. There's plenty of information on online about these things. And then we go to the news. Okay, so news does not tell the story. Even if we just look at the last 2 weeks or 3 weeks on CHSB, for example, okay, we've seen many times where price has ran up on the rumor, and people have sold on the news, or people have this expectation that when the news is released, and it's positive, that price is going to explode and go ripping to the upside, and we simply haven't seen that. News is very specific, okay, in the sense that if you are using the news, you have to use the news in a contrarian manner, okay? You have to be able to look at the news, any news releases, and kind of get a feel for the opposite side of what they're trying to accomplish with the release of these news. We know, and if anybody doesn't, I'm telling you now, the news, sometimes when we read news online and it's delivered, one of the easiest ways to verify this is if you know somebody else in another country, have a look at the news, okay, for that country. Just go online, go to Google and have a look at the news. I know we're talking market specific, but I just want to give you guys an example. Have a look at the news for that country, and then once you've read a couple of headlines, Talk to the person that you know in that country and get them to tell you what's actually happening in that country, and you'll find in almost every case the story is completely different. Yeah. Now, in the markets, cryptocurrencies, forex, commodities, futures, when you're reading the news, okay, remember you're being told a narrative, okay, and that narrative pretty much will always be swayed towards big money. Yeah. For big money to be able to manipulate the markets in a way where they can capitalize and make money. All right. They're not interested in you or helping you or delivering news to you that's going to be beneficial. Another way to verify this is if the news that we see, for example, was real time, not delayed, and can be used to time the market, why are there services available through Reuters and some of these other, big companies, news outlets, and so on, that have services running in the thousands per month? Yeah, thousands and thousands of dollars or pounds per month for real-time news services. Yeah, it's insane. If it was real-time news, what we're seeing, you go to Bloomberg or CNBC and some of these, I can't even remember now. It's been such a long time. MSM Money or whatever. If the news was relative, if the news was constant, if the news was, real time, there wouldn't be services from these companies for real time news. Yeah, so just bear that in mind. And context is extremely important. Everything that I've ever taught and every person that I've ever spoke to, every video that I've ever done will always contain context as the most important factor. Okay, if you do not have context in anything that you're doing with your trading, your methodology, your system, or whatever the case may be, it's just not going to work. And that's a fact. It will not work. Context is very, very important. You have to understand how you've arrived at the point you've arrived at. If you don't understand that, then your indicators won't work. The news won't work, regardless of however you look at it. If you found a way to manipulate the news to your advantage, for example, the liquidity won't work. The way that you enter won't work. None of it works because you have to understand the context. If you understand the story of how you get to where you're getting to, then you have some context to look back on and learn from. Okay, same with the markets. When we're looking at price, when we're looking at the charts, we have to arrive at a point where we can say, okay, price is at this current level, but I know why it's there. It's there because X, Y, Z, happened, and now we're sitting here. So that gives me so much more insight to have more confidence going forward as to where price could potentially be going. Yeah. So if nothing else in this video really hits home, make sure this one does. Context is very, very, very important. Okay. So here we have a chart. All right, and I've made some notes on this chart. And before I continue, okay, and explain a few things, please bear in mind, that whatever I'm saying isn't a one fits all. I understand what I'm looking at on this chart, and by the time I finish, just kind of briefly going over some things, you'll have a little bit more of an insight into what I do, and a little bit more insight into how you can apply this to your own trading and your own chart viewing, with or without indicators, with or without volume, with or without the news. Yeah. So, and it's not it's like I said, it's not a one fits all, and this is literally just a drop in the ocean. Okay, but it's going to help. So over here, I've made a reference to this area here. Okay, and what I want you to pay attention to is the fact that there is a high that was created here, and then price ran away. All right. So as price is running away, the first thing you need to think of is, okay, now we know where price is over here, right? So we need to figure out these points all the way across, and then when we finally get to here, we're like, okay, do you know what? It makes sense that price is going to go, say, here, or or here, because we know the storyline. Yeah. So we have this area noted, and price runs away from this, and as price starts to kind of grind back up, we start to pay attention to how price is going back towards this level. It doesn't mean it will. We don't know that yet. But what we do know is that price is from here, as it starts to run up, we know that it's getting closer to this level. Okay. It was here, so it's that much distance away from that level. Now it's here, so it's this much distance. It's getting closer to this high. Okay, great. Price pulls back a little bit, then it starts to run again. And remember, you're not trying to anticipate and say, okay, look, I'm guessing that price is going to come up here, so I'm just going to buy. We're not doing that. We're trying to figure out where price is going. So price starts to run up again. Okay, it's getting closer to this. And then we get this pullback, a little bit of a gap, drops down. Okay, now here's the interesting thing. And these are the things we pay attention to, whether we understand them or not. We pay attention to them. Price comes down and then it starts to run back up. Okay, and we say, okay, well that run just there took out this low. Okay, so something happened there. Okay, so you make a note of this. Something happened there. I don't know what, but I know it went as low as this low and lower, and then it started to run away from that. So it's quite significant. It takes out this high and it starts to run, and then it accelerates into what? The liquidity that is above this high. Why is there liquidity there? It's not the scope of this video. Yeah, just trust me that there is liquidity here, and we know that there's liquidity there because price accelerated into this level and it took out this high. Then it rejected. And there's your bearish engulfing, for example, if you want to take that as an example. The reason I've noted it here with the star is to just illustrate the fact that this run is the one that takes out this high. Okay? And then price starts to run lower, okay? And then price comes up again, comes close to this high, and then starts to grind lower, and then we start to progressively get lower highs, and then we come all the way down here. I've noted this one just to illustrate one point, and that is that the context of one candle can sometimes, in very few instances, but in this instance it does make sense, can give us a lot of information because it's extremely volatile, extremely aggressive, and it's a very, very pronounced candle. Okay, and when we look at some other time frames to confirm where price ran to and stopped, and then it reversed and started to grind back up, this gives us a lot of information. Okay, so this is one of the very rare instances that that happens. So what I want you to get from this, okay, is that there was liquidity above here and then price ran into that liquidity and started to move away. Okay, fine. Now, as price comes up, I've made another note here, okay, and this area here that I've noted with this star is just showing that this move took out this high. Now, one of the questions that I'm often asked is, how do you identify liquidity pools? And my kind of default response to that is, just go with the flow. I don't like just telling you. You have to kind of work it out for yourself. But, there is, or there has to be, a fundamental starting point or a foundation where you can say, okay, look, I've got a general idea. Now I'm going to kind of work up from there. Because I've spoken and coached and mentored many, many traders throughout the years, okay? And because it's such an individual thing, in terms of me working on whatever specific problems, each individual trader has, it's always been very difficult for me to just put everything into a small box, okay, and say, well, this is going to fit 50 traders. It simply doesn't. The understanding of where liquidity is has to be based on the way that you personally view the markets, okay? You have to first, before you do anything else, realize that your whole view of the market, how price is delivered, how orders are placed, how orders are executed, how orders are fulfilled, and so on and so on. You have to understand all of that first, and you have to shift the way that you're thinking. I look at price as a living, breathing entity, okay? Now, when you say that to somebody, they're like, that's so absurd. What are you talking about? And yet they see me pick points, and levels, pick points and levels where price pretty much trades to almost immediately, or in a time frame that I've specified, and they look at me and they're like, well, how are you able to do that? And I'm like, well, look, like I said, you've got to look at price as a living entity. You've got to look at price as the only thing that matters. Yeah. And until you're able to do that, you're never going to be able to understand where the liquidity is above these highs, the liquidity here, there is liquidity here that was raided and that's completely gone now. And now that, now that's gone. And you're not going to be able to see that unless you understand that price is this way. Yeah. So as a good sort of starting point, when we look at this chart like this, okay, and I suggest you use this chart, right? Maybe take a snapshot of it on the video, pause the video and take a snapshot of this, okay? Start from here, okay, and start to look how price is moving and how it's reacting. Pay attention to the wicks, yeah? Pay attention to the wicks, pay attention to the highs that are taken, the lows that are taken, the major ones, this one, this one, this one, okay? You know, and some of the minor ones, for example, like this one, we can see it was taken here, okay? You can see that this low here, after the reversal, was taken here. You know, you can see that this low here was taken by this one, but it didn't quite get to this one. Eventually it does though, yeah? And go through the entire chart and start to track every single candle. If you really want to understand how to learn and learn to find liquidity, you have to do this. If you don't want to do this, then I can't help you, yeah? But you have to be able to go through, spend the time, an hour, 2 hours, however long it takes, right, and go through each one of these and start to look at how price is reacting around these levels. Look at the wicks, you know, and this is going to help you to identify potentially where these liquidity pools are, right? So I'll give you some examples and then I'll kind of leave the video at that. And I will just say as well, I'll just preface by saying, you know, not preface, sorry, I'll just quickly say, you know, I am in the process, okay, of recording a complete library, you know, of all of this stuff, right? But I'm doing it in a way, I'm doing it in a very meticulous way, okay? It has to be very specific and very generic. So so once everybody kind of goes through that, or if somebody goes through that, then I can start breaking everything down with that individual based on what they're trying to accomplish. To illustrate that point, when you look at this chart, this could be a 1 minute chart, a 5 minute chart, a monthly chart, a weekly chart. And each one of those time frames, you know, gives you a completely different picture, but the liquidity is the same regardless, yeah? So you might be a swing trader, or you might be a day trader, or you might be an investor, a long-term trader, whatever the case may be, and because of that, that will change how you view this chart, yeah? You know, depending on what time frame that you're on. So bear that in mind, you know, while you're doing this exercise. Understand it's not easy. Okay, this isn't a simple process. This isn't a you're going to learn in a month and off you go. Yeah, this is a very deep understanding of what you're seeing on the charts. Yeah, and being able to apply that going forward. Yeah, anybody can do this in hindsight, but being able to apply it going forward, that's what matters. Okay, it doesn't mean that we're always right. It doesn't mean that I can always pick the market tops and bottoms and this and that. It's not about that. But I found a way to be able to incorporate this into my trading. You know, where I can get in where it makes the most sense, reduce the risk, get my money, and walk away. Yeah. So go through each individual candle. Then, once you've done all of this, okay, start to pay attention to clusters of areas. Yeah. So let's say I'll find a nice one for you, and then I'll let you kind of work the rest out. So let's say we take this section of price right here. Okay. Okay. In fact, you know what? No, we'll do it this way. Split this chart up. I should have done this actually. Sorry, guys. Split the chart up into sections. So we do this section here. Okay, and we start to look at this down move. Okay, and we work it out candle by candle. Okay, price accelerated, and it held quite strong. So we've got a nice strong down candle right here. Okay, fine. Next candle slows down a little bit of up, bit of down, kind of finishes neutral. Then it goes down again, starts to pause here. Okay, so it drops and then it slowly stabilizes. Okay, and then it drops again. What happened right there? Something happened. Something had to happen, because price didn't just go down, 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 down in just one consecutive strong candles. You know, we haven't seen, or we don't see, 10 of these candles in succession. We see some ebb and flow. We see something happening in between, within the wicks. The wicks represent where price went to and then moved away. Yeah, we can see it with this candle. Yes, fine, but this is one progressive candle. This candle shows us that price went up and it moved away. It went down and it moved away. Something happened here. There's an ebb and flow. Same here, where price paused a little bit. There is an ebb and flow. Price is doing what? It's facilitating trade. There's some buys, there's some sells, but it's almost an equal amount, because if it wasn't, If there were more buys, price would stop and go up. If there were more sells, price would continue to go lower. That's not what happened on this candle in this small pause here. Price stopped, stabilized for a little while, did whatever it needed to do, and think about this. If price needed to fulfill orders here, it obviously did it because price continued to go lower. So we're still continuing to see the downward pressure, downward momentum. What does that mean? What's that telling us? Think about it. Think about that. Price again, a little bit more volatile on these wicks, but again, continuation to the downside, continuation to the downside. Then what do we see? We see a complete slowdown here. Something again has happened, okay, and we can look at lots of different variables. Whatever orders were picked up here for the sell, okay, are being dealt off here all the way down and fulfilled down here as price starts to go back through its ebb and flow and efficiently traded price delivery. Okay, then we start to get a move up. So we take the next chunk of orders here, okay, and we start to break this down and we start to look through and we start to try and work things out. And the idea is you're trying to figure out, as price is ebbing and flowing through, okay, you're trying to figure out what is the buy to sell ratio. Yeah, is it more buys or is it more sells? Yeah, it's not always an easy thing to find, but you have to be able to first understand this way of looking at price, and when you do, then you can start figuring out, okay, it ran up here, you know, it ran all the way down here, it starts to accumulate. So any sells, so let's just say it like this, a company, we'll just use the word company. Company buys, or sorry, company sells a huge amount here. Price goes all the way down here, you know, and they buy it back here for a profit. Fine. Price starts to run back up. Everything's looking great, and while they've bought back to get out of their short position, for example, they've accumulated a lot of buy orders. Yeah, now they need to offload those buy orders. Okay, and yes, there will be some liquidity on the way back up. We can see that as price is reacting at these specific levels, this level, this level, this level, but eventually price starts to accelerate to find that last portion up here. So price is seeking from this point here, it's already seeking the liquidity that's above this high because it knows that's where it is. That's where the biggest amount of orders are going to be. So price drives all the way back up here to eventually offload all of those positions, go back to neutral, yeah, and then it starts to go through its next phase. So we start to take this chunk of price delivery, okay, and we work out all of this, and then we take this next chunk and we start to look at all of this. Now I know many of you will watch this video and maybe pick up a few nuggets here and there, but say, yeah, but you're not really telling us. I can't. I will read a message, okay, that I got. Well, I can, but you'll understand in a second. I'll read a message that somebody sent me today, okay? And the message was, one question that has been at the back of my mind when you talk about liquidity, does that equal peeking into the order book? Do you mean orders which have already been placed on exchanges, etc.? For instance, resting orders at specific level or stop losses, etc., or orders which also have not yet been placed. For instance, me thinking I'll buy more X, I'm not going to say what it is, at a certain level or sell another. My answer was neither. Yeah, I said I was talking about reading price, and I can't explain in a message, and I'll mention in the video. This is the video. When I am teaching people to read price, okay, and to look for liquidity pools, all right, I'm trying to make a reference to not the order book. I can't see the order book. Nobody can see the order book. We can see some bits of it. We can see some volumes. We can see time in sales. We can see whatever. But they're not the orders, guys. They're not the real orders. The only way that you're ever going to understand the order book the way it should be understood is if you are working so high up in a bank or so high up in a central bank or in a place where, to be honest, you wouldn't really want to find yourself, because that type of understanding of reading the book is so manipulated. You'd have to be that kind of individual to manipulate, to benefit from that manipulation, knowing that people are getting screwed. Yeah, I don't know anybody like that, and I certainly wouldn't want to be there. But you have to kind of look at or understand from my point of view. When I say reading orders, I am talking about knowing on the chart where the liquidity is and how relevant that liquidity is based on everything else that's happened, i.e. the context. Super, super important. So people do get frustrated when they hear me sometimes and like, yeah, again, you're not, you've said some good stuff, but you're not really, kind of going into it. I have gone into it. I have taken traders, guys, who know absolutely nothing about this stuff, okay, and in a year they are so far ahead of the curve in terms of where they were, how they're trading. I know one guy that I that I was mentoring, who went from literally zero, okay, to 2 years later starting his own prop firm. Yeah, this stuff can be taught. It's not a question of whether it can be taught. It's a question of how much effort you want to put into this. Okay, some people aren't interested. Some people are like, yeah, God, you know what? I'd rather just buy and hold. It's fine. But for those who are really into this and really interested in the way price moves, in the way that you can really put yourself in the best possible spot for risk management, risk reduction, entries, timing your entries, even for investors still want a good price. They don't just throw money into the market and say it doesn't matter. They still want a good price, okay? So this has value for every single person in the way, regardless of whether they're trading commodities, whatever time frame, commodities, futures, options, cryptocurrencies, Forex, it doesn't matter. Stocks, blah, blah, blah. It's all the same. Price is delivered in exactly the same way. All right. So I'm really hoping that this video kind of helps, to at least give you some insights into some things that are important, some things that you should do, some areas that you should kind of focus on, things and the way in which you can start to understand by breaking the chart down and spending time. I can tell you this, if you take this one chart, okay, and this is very specific, guys, what I've done here, yeah? These areas that I've noted are extremely specific. They're not just relevant to what I've just said previously as I was going through them, right? I know the next 15 steps ahead, yeah, in terms of why these are going to be important as you're studying this chart. Study the chart, yeah, really go through it, make notes, make multiple copies if you have to, print some of these off and use pencil or whatever and start to make a reference, make a reference to the swing highs, make a reference to the swing lows. How are they important? Where did price run to? Why did it run there? If you don't understand why, put a question mark, yeah, go back to it, revisit it, spend time on this chart. Break it down in every single possible way that you know how. Any questions, put them in the comments. Get back to me. Throw it in the chat. Wealth and Trading channel, so on. If you are super interested and you really want to get into this and you really want to know, some of the things, take this chart, for example, write a note on it, post it in the chat. So, with your question, I'll take a look, and I won't always clutter the chat up with this stuff, but I'll try to kind of get back to you in a way that's not going to be causing problems with the chat itself, because it is a wealth and trading chat. And I want to kind of keep it germane to that, so to speak. I don't want to clutter it up, but ask questions, but do the exercise, and don't just do it once. Go through it, man. Go through it, work it out. There's a gap here. What does that mean? Well, how did price react around this area? This low here. Why is this low important? Where did that low stop? Well, it stopped here. Okay, how is that important? Does it matter? I don't know. Maybe. Yeah, look at it. Break it down. Look into it. Go through the entire chart, candle by candle by candle by candle by candle. And if you do this, trust me, your insight will increase, your understanding will get deeper, and you will start to make sense of everything that you're seeing in front of you on this chart. But as a last warning, don't take anything that I've said in this video as, okay, now I'm just going to go and do this, because don't do that. Understanding is the most important thing. Context is the most important thing. Those together, it's kind of the same thing. Context, understanding, foundation. You have to have all of that first before you apply anything that you're learning or seeing, regardless of whatever the methodology, whether from me or from somebody else, because you need confidence. You have to have confidence in your ability to be able to make this work. So with all of that said, guys, I'm going to leave it at that, and I will catch up with you guys very soon. Take care.